We just witnessed the largest drop in market capitalization from a single stock in history. $240 billion of wealth was wiped out in one single day for investors in Meta or Facebook. Ready? Let's dive in. All right, guys, take a look at this chart with me. We are looking at Meta Platforms. They recently changed their name. Stock symbol is still FB. I think META might actually be taken. Let me double check. Yeah, it's taken. So if they do change their stock symbol, they're not going to be able to change it to Meta. But take a look at this. I've got two panes here on my chart. The top one is just their share price. And then this bottom one here is the market capitalization. So for those of you who aren't aware, market cap is the total value of the company. You calculate that basically by taking the share price and multiplying it by the number of shares there are available. So if you own a small business and you own 100% of it, then there's one share, right? And so publicly traded companies have millions, billions of shares. So you have to look at the share price, see how many shares are there. That's basically like slices of a pie to figure out what the size is of the total pie. Now, before today, Facebook, Meta, was trading, was worth about just under $900 billion there, 898. As of the close today, market is closed. It's trading at just under $660 billion. So $240 billion worth of wealth in investors in Facebook wiped out in one single day. So couple things to note here. Number one, wealth is not a zero-sum game. Wealth can be both created and destroyed. We know this empirically because today, wealth was destroyed. Nobody got those $240 billion. Yesterday, the people who were buying and selling Facebook shares were happy to trade them back and forth to each other right around $325 per share. Today, nobody was willing to buy them for $325 per share. Instead, the only price that buyers were willing to buy Facebook at was right around $230 to $250 per share. So the buyers dried up until the price dropped. So sellers, if they wanted to sell, they couldn't sell unless they matched one of the buyers' prices way down here. That's not that somebody got transferred $240 billion worth of wealth. It evaporated. It got destroyed. Similarly, there's a lot more wealth in the world today than there was 100 years ago, 200 years ago, 1,000 years ago. Wealth has grown exponentially over time. It's not the same amount of wealth that's being divided up, little by little among billions of more people today. It's more wealth. And so wealth is not a zero-sum game. It can be both created and destroyed. And investors in Facebook, Meta, just saw $240 billion worth of wealth destroyed here. Now, we also saw some significant losses in some other stocks today. We saw a little bit of a drop in Twitter. We're seeing a big drop recently. What's the stock symbol for Peloton? PTON. We've been seeing a big drop. Peloton is one of those stocks that I never understood why anybody bought in the first place. You're selling exercise equipment that's the same exact exercise equipment as everybody else is selling. And everybody piled in at the beginning of the pandemic here, and our prices are basically back down. Peloton recently announced that they were, some employees are saying that Peloton actually owes them money on their wages. They're not paying their salaries. They're laying people off. They had just halted production. So demand has dried up so much that they're not even making products anymore. So this is just a basket case. This is just a bonfire right here. Netflix also came out with some disappointing numbers, and so we're seeing some of these stocks. Not Apple. Apple's doing pretty well since they came out with earnings. They're one of the only companies, which brings us to the answer of why Facebook has done so poorly. Facebook makes all of their money basically from advertising. And a lot of their advertising is done on platforms like iPhones. And Apple has recently made it a lot more difficult for apps like Facebook to have accurate advertising to track the people, basically. And so advertisers are not willing to spend as much money on ads that they're not sure are getting to their target audiences. Now, from the customer's point of view, you can look at this one of two ways. One way to look at it would be like, well, hey, as a customer, now I'm not getting notified about the things that, I may want to buy that I just don't know about yet. And so you can make an argument that I disagree with, but you can make an argument that, that's a worse customer experience. Apple feels the opposite. Apple feels that tracking and doing some of those targeted things are a little bit too invasive of privacy. And so, advertisers are going to have to adjust. And they think that's a better consumer experience, going for more privacy rather than more, targeted ads. And so Apple's done pretty well. Facebook has not, because they make most of their money from the companies who pay for those extremely targeted ads, and you just can't do that as well, at least now on iPhones. And so they've had a big plummet in revenue as a result of that. This highlights another thing that I talk about kind of as a heuristic about investing. And no matter what the company has done or looks like they're planning on doing in the future, I never invest in a company whose products I despise. Now, that means I've missed out on a lot of great companies that have done very well. But it also means I avoid a 26, 27% drawdown in one day because I can't stand Facebook's products. Can't stand Instagram, can't stand WhatsApp, I can't stand Facebook. I don't like the company and I don't like the products that they make. I say the exact same thing. I made videos about this. That's why I didn't invest in Coinbase, because I cannot stand their products, cannot stand the way they make money. I don't like Coinbase. Same reason why I didn't invest in Robinhood. Again, look at that. Avoided this massive drawdown because if there's a company whose products you absolutely despise, there's a good chance that a lot of other people feel that way. And if you despise them, there's got to be a good reason for it. Maybe the company is shady. Maybe they've got terrible customer service. Maybe they do things in a way that you just find is immoral or something like that. And there's a good chance that eventually, if those reasons are legitimate, it catches up with the company. And I don't know anything about what the future of Meta is. I don't follow the company closely. I know they're getting into virtual reality and the metaverse and all of that, and they could perform very well going into the future. I just don't like the business, don't like the products, so I stay away from the company. And so this may look to some people like a buy the dip opportunity. One thing to take note of, though, the S&P 500 dropped. It did drop a little bit here. We had a drop here. What's the percent from yesterday? We had a drop of about 2% from the close yesterday. Now, that's significant. It's not the biggest one that we've seen recently. The NASDAQ dropped obviously a little bit more. Dow Jones a little bit less. Russell 2000 about the same. So one thing to notice here is that all along the way, for months now, FANG, the big five, have basically been carrying the stock market. Microsoft is one of them, still doing pretty well. Apple's the other one I already showed you. Google is another one that's still doing pretty well, although it's a little bit of a sell-off now from just the general sell-off today. And so some of the big, Netflix is down, Facebook is down. So some of the big carriers of the market are now not doing so hot and they're dragging down the index. But overall, now we're getting to a point where it looks like things are flipping, that maybe it's the big five are not going to be continuing to carry the index anymore. And we're going to start to see the rest of the index start to pick up its weight since it's underperformed for so long. And it looks like maybe some of these super overvalued giant tech stocks are kind of finished here. Not a prediction, but this doesn't look to me like the continuation of a massive stock market drop. It looks to me like we still have a huge melt up to go before things really start to get ugly. We've got a few leading indicators, a few canaries in the coal mine like Facebook saying, hey, this could be coming sooner or later. And personally, I think that the big crash starts to happen towards the end of this year once the Federal Reserve actually starts tightening. reducing their balance sheet, raising interest rates, and that starts to cause insolvency. That starts to cause debt costs, debt service costs to rise. I don't think something like this is enough to knock down the entire market. You're going to see some pain in some of the most overvalued stocks, certainly, but the indexes overall look to me like they're going to continue to drive higher and higher into Fed tightening. That's going to give them the ability to continue to tighten. They're only looking at job openings. I mentioned this before. The Federal Reserve is only looking at job openings in terms of how far can we tighten, because right now they're trying to fight inflation. Maximum employment is part of that dual mandate. Maximum employment on one side, inflation on the other side. They're usually opposing goals. And so job openings right now are what they're looking at, and they'll continue to tighten until job openings dry up and layoffs, firings, employment starts to really crater. But as long as job openings are up, even if the labor force participation rate starts to drop, even if unemployment claims start to go up, they're looking at job openings, because they're saying, hey, if some of these other indicators are looking bad, but job openings are still there, then we still have room, because at least companies are still offering the job. And if push comes to shove, people will take those jobs. So that's the only indicator they're looking at on the employment side. And that's what they're looking at to see how much room they have with tightening. And so they will tighten until things break. And this doesn't look to me like the sign of things breaking yet. I think down the road, closer towards the end of this year, absolutely. But it looks to me like we've got a lot higher to go. I could be wrong. Don't make any investing decisions off of somebody's opinion that you watch on the internet. As always, really appreciate you guys. Thanks so much for watching. Have a great day.